All right, I want to move on to one more paper of yours that's in the review of financial studies on on fixed income during COVID-19. This another just fascinating paper. Can you talk about what happened in the U.S. investment grade corporate bond market in March of 2020?
It blew up. Uh, it completely blew up, and that's no. So COVID was a terrible period for humanity, I think. Actually, not I think I know. Um, but something was kind of interesting happening in finance, and I'm a finance professor, so it's looking for the cure for COVID. I looked for that, but I something that happened is that it started like late February, March, 2020. As the pandemic was expanding, markets started to crash. And this is a really unprecedented crash due to its speed. So the one I think many people paid attention to at that time, just because we're used to follow the stock market, was the stock market. So the stock market dropped a little bit more than 30%, and maybe even quite a bit more than 30%
Wow.
over a few weeks. If you go back to 2008, for example, it was a massive stock market drawdown, but it took 6 months, 9 months. The bottom of the market was in March 2010, 6 months later. This was just over a few weeks. So that's already a pretty strong event. But what we found out is that if you look at corporate bond, and so in particular, we looked at investment grade corporate bond, so the safest of corporate bond, their price dropped nearly 20%. And that's unprecedented because stock prices are extremely volatile, but bonds, we expect them to be safe, and safe bonds really safe. So that almost never happened before, such extreme movements. So that kind of got us puzzled. Like you have to imagine, this is the beginning of the lockdown. I'm with my co-authors. We're locked down at home, and we look at the news every day, the financial news every day, and we see this happening. And we had done a lot of work before on like how financial institutions can create crises. We have done a lot of work around the 2000 crisis and so on. But that looked like nothing we had seen before. So we wanted to dig into this some more, pretty much.
And how did the response in the bond market differ from the credit default swap market?
So that's interesting. So the way you can think about, this is a simple way to think about bond prices, corporate bond prices. Is the price is going to be down if the company is likely to default. So that would be the natural explanation, at least at first glance, for this period, is to say, well, we're going to have a big recession due to COVID. Many firms are going to go bankrupt, so that's why we see the price go down. But there's another place where you can get that information. That's the credit default swap market. So there are contracts where investors buy and sell insurance against default. And so if this insurance is expensive, that means that likely the company is likely to default. And we didn't see the price of those insurance go up during that period for those sales. It went up a little bit. I shouldn't say we didn't see it go up, but by a small amount. To give you a concrete example, and that's kind of my favorite example of this period, is to look at, if you look at Google at Google. So Google is an extremely safe company. First, before even I tell you any price number, there's no reason to believe COVID-19 was going to do harm to Google. If anything, this was we all spend more time on computers. This was good news for Google.
Yep.
And if you look at the CDS, or the credit default swap for Google, the price didn't move. So I think it cost a few basis points to insure against the default of Google, something like 50 basis points. It went up a little bit, but if I show you the plot, it looks pretty flat. The price of a 5-year Google bond went down to pretty much 80 cents on the dollars.
Wow.
So that looks like it's pricing a massive risk of default for Google. But again, once you look at everything else, you don't see this risk of default. So we like credit default swap because it's also a price, it's also in the market, and you didn't see this price move. So you just see the price of the bond itself go down. And that's something that told us that something wrong was going on in markets, more so than like with the way markets worked, more so than with Google itself.
Man, that's interesting. So
Yeah.
that you see the bond prices tank. You think it's the price of risk is increasing, but then you look at another place where you can see the price of risk, and it hasn't actually changed that much. So what was causing the crash in bonds then?
Okay, so that's where kind of like the detective part of the paper starts. So a natural guess, I mean, actually, the natural way you would describe it is that, well, people don't want to buy bonds, or more precisely, people want to sell bonds, but it's not because the bonds themselves are risky in a way, it's because people want to offload positions. So that's what you would call a fire sale, a massive fire sale going on in this market. And so then we try to ask ourselves, well, who are the investors selling, and how come this has such a big effect? And here there's a few dimensions you can point to. A big one, maybe the biggest one, and even after our paper, people have done more studies, and I think that's the one that seems the most important, is that bond mutual funds sold a lot of positions. So a lot of bond mutual funds experienced very large outflows. And what a lot of them did, not even funds specialized in more safe bonds, but a lot of mutual funds would sell their safer bonds first. So you have to imagine, even if you have a mix of investment grade high yield bond, you get a big outflow. It turns out the funds chose to sell the more liquid bonds first, the usually more liquid bond first. So kind of everybody went to all those funds went to like the simple rule of thumb that is, by the way, a good rule of thumb 99% of the time. That is, if you have to sell liquid assets, but it is so much so that then the liquidity deteriorated a ton in those markets. So that's one big aspect, and that's a little bit that's unprecedented, because until that period, pretty much until 2008, we didn't have very big bond mutual funds in the US. I mean, there are some big ones that we know, like PIMCO was actually in bond mutual fund, all this stuff, but most bonds were held through insurance companies, through much more stable institutions. After 2008, we saw this big growth of bond mutual funds, and that is completely kicked back the economy, because with the outflows, there was just massive sales.
So why weren't market participants stepping in to buy the bonds as these prices fell?
So you have to ask yourself, well, who can step in and try to look for that. So there's various people you can look at. So one category that historically plays a role when there's those like acute episodes are dealers. So the bond dealers, so you think about like large investment banks and so on. So historically, they intermediate a lot of the trading in this market. And so they would say, oh, we have an acute crisis. We're going to buy those bonds, keep them on our balance sheet for a few days. Things will cool down, and we put it back. In this case, there were two concerns, I think, that prevented this from happening. One is first a reality that dealers cannot intermediate as much as they used to. We just have much more regulation in the market preventing that. The other one is that this crisis and the pandemic, and it did last quite a long time. So there was a sense that even though it's very acute, it can be a long-lasting problem. So what we would need is investors that can wait it out in a way. Mm. So that kind of kicked out the dealers. Like the dealers, even when they had bigger balance sheet capacity, didn't want to take on assets for a long time. So there was a lack of this long-term absorption capacity. Now you could look for other investors. You could say, well, maybe insurance companies could step in. Insurance companies, a lot of them didn't step in. So de facto, they didn't want to step in too much. They tend to be much more stable in terms of their inflows, outflows than bond funds. But they start to worry, because as the price of the bonds drop, if it drops too much, the company will go bankrupt. Mm. And so it seemed like they were worried and not that willing to participate. Some did participate. I think I might be quoting the wrong one, but I believe like MetLife, for example, did come into this market a bit during that period, but just not nearly enough to stabilize the market. There was not enough capacity to come in. So what was needed at this point was to come in on short notice and to be able conveniently to say, I'm going to come in, I'm going to hold up throughout the pandemic, roughly. And that nobody, it seemed like not many investors were willing to do it. We talked to something interesting. We even talked to pension funds, large pension funds. I guess I cannot tell you which one, but a large pension funds, and they asked us to come talk about this research. And what was interesting is that the people managing the fund were telling us, we knew this. We knew there were good deals. We could see those good deals. But it's just our management was like, it's the crisis. We're not going to suddenly start to switch to buy tons of bonds out of nowhere. We cannot switch our policy. So there's also just a bunch of frictions in a way that makes that a lot of investors cannot move into a market that fast.
Wow, yeah, that's super interesting. Sounds like a job for the Fed. What effect did the Fed's intervention have?
So the Fed did it. So the Fed did step in. Actually, well, did say they might step in. I should say, to be precise. So what happened is the Fed did something they never did before. They stepped into the corporate bond market. So in 2008, the Fed did QE, so that was one of the first time they would say, well, we buy long-term treasuries, we buy mortgage-backed securities. But even after that, I think most people thought this was very limited to treasuries or treasury-like securities. I think there was always this idea that you shouldn't participate in stock market, you shouldn't participate in corporate bond, you shouldn't start to decide which firms are doing better or not. But in a pretty unexpected way, they just stepped in and they said, we're going to create those institutions. So it was the primary market credit facility, secondary market credit facility, and we're going to absorb some of those bonds. And so they said at first they could buy up to $300 billion of corporate investment grade corporate bond. Later it got expanded in different dimensions, but up to about $800 billion. So that's a big stepping in. And the day they announced that, the market recovers. I think about a third of the crash recovers just that morning, pretty much. What they announced.
Oh. Is that good for markets?
This is a hard question. So actually, I'll tell you about it. So I'll tell you briefly about some other paper we've done, and that's going to amplify. That's not going to answer whether it's good or bad, but it's going to amplify the debate, I think. So they said we can step in up to $300 billion, and later we can step in up to $800 billion. The market did recover, and it turned out the Fed never really stepped in. The Fed only bought something like $14 billion of assets. And everything got by the fall 2020, the Fed is not owning any corporate bond anymore, pretty much. So what happened? So then we have another paper where we think about those issues, and what we think is that there was a possibility that the fire sale could get even worse. And what the Fed did really was say, well, I'm willing to do whatever it takes to fix it. So it turns out the pandemic was not as bad as people thought it could get. It was extremely bad, just to be completely clear. But it was not as bad as we thought it could get. And so really most of the Fed intervention did not happen. It could have happened, but it did not happen. Okay, so why does that make things kind of worse or more stressful? Is that the positive side is, well, that's great. They can stabilize market, and the experts didn't know much, so then there's not much cost. The worrisome part is, well, they might be willing to step in again. And now they kind of like open Pandora's box and create this implicit commitment. That's another form of Fed put that they will always step in when things are risky. We try to look a little bit in that subsequent research. Do we see traces on that? And we see some traces that suggest a little bit of this. So if you look since 2020, like after the pandemic cooled down, the price of investment grade corporate bond, if anything, seems too high. So it looks, and if you talk, I mean, it's hard to tell, but if you talk kind of casually to a lot of investment grade bond trader, I don't know today, but I haven't talked to them recently, but like even a year or two ago, they will tell you the Fed is in this market somehow like this. Like even though they're not intervening, there's a view that the possibility that the Fed steps in is just propping up the market.
Wow.
And that can be worrisome, that creates moral hazard, that creates issues of the Fed stepping in too much. At the same time, markets are not perfect. Like this is not the crash to start with is not an efficient market phenomenon that we want to let happen. Like it makes sense that we want to fix this. Like the reason they step in so fast is they didn't want 2008 to happen. They didn't want this to spill over somewhere else. So to me, I view it more as like there's a cost benefit trade-off. I think the view, at least in my mind, we're past the world to say the Fed should never intervene in markets. We should always respect market. Like when I look at this episode, everything screams that something wrong is going on in the organization of markets, that there are frictions and that it makes sense for a policymaker to intervene. The problem is that once you come in once, you build commitments to come in again, and those commitments might be costly.
Yeah.
And that only time will tell us.
It's a great answer to the question, but it highlights how messy this system is.
Yeah, extremely messy. Yes.
Yeah, crazy. What do you think the implications of this research are for the safety of bonds in a crisis?
If you look before the Fed, what we learned, I think, from this episode is the corporate bond market is much less stable, maybe than it used to, and that we thought it was. And there's been a big debate actually before even that crisis. So even before that crisis, there was a big debate that is like, if you look at everything about the corporate bond market, it looked much better than before. Actually, it looked much more liquid. Bid-ask spreads were small. And it's because, bond mutual funds, ETFs, also like that, we have big growth of bond ETFs. So everybody's trading bonds. The market looks like it's better. But what we learned is that this liquidity is very fragile in a way. That is, you can have these big outflows and they can destroy everything on their way, pretty much. So that's one lesson. I think the lesson in terms of how to fix it, to us, we keep going back to this thing that what we need is not just better intermediation. So a lot of the lessons from 2008 was intermediation is really important. What I mean by that is like, we need to have a good trading system. We need to be able to move those bonds around fast. In that case, it was not a question of moving the bonds around. It was that we needed the ability to hold those bonds. People often use this analogy of like, the types of finance matter a lot. In my mind, that was not the problem. The problem were not the pipes, was that we needed like water tank. Like we need a whole tank to hold the assets for a long time. And I don't think even like, now we're like 3 years out, we've made big progress in having those. So I would still be quite concerned for the stability of those markets were we to have another big negative shock. And again, the shock was not starting in corporate bond. It was just a negative, broad economic negative shocks. And that just propagated in this market.
What do you think is a safe asset in a crisis?
So far, treasuries have done okay. We saw actually the even treasuries, there was some notion that, there's a safety premium on treasury typically, that this premium was getting even negative, that people just needed cash. COVID was special in some sense. So I think this episode really highlighted some fragility in the corporate bond market, but I think it's not clear that many crises would look like COVID, because it was a crisis of cash, really. That there was a sense, particularly at that point in time, that a big consequences was that business were going to be closed for a while. This is a world where you have to shut down for a while and open later, so that you need cash, pretty much. That's the only thing you need. You need to like survive for a few months. And that made the only safe asset was cash. At least from the point of view of investors. Like nobody knew, because this all happened much faster than the horizon at which you need the cash, but that's what I think everybody was looking for. That like clearly we learned that we shouldn't say that it will never happen again, but this is very specific, I think, to this type of crisis. And many other recessions, even large recession, large crises, don't look like that. And so I think, safer assets can hold their safety in those periods.